There are a lot of traps in day trading. After you enter the market, it doesn't go your way. Instead, it goes to the opposite direction, so you end up losing money. Let me show you an example and find out some possible solution to deal with traps. Let's take the ESE Mini S&P 500 5-minute chart on July the 28th for example, but this can apply to any of the other instruments like the other futures, gold, crude oil, or forex. This is the bar at 9:30, and then after that there's a breakout to the downside with 4 consecutive bear bars, and then we wait for the pullback and the signal bar, then we enter the market. Depending on your strategy, you could enter at this bear bar if you put your stop order at the bottom of this bull bar. Or if you wait for this bear bar to finish, you can enter at the bottom of this bear bar, or you can enter upon the finish of this bear bar, so using market order. The market didn't go down further, instead it reversed to the backup, so if you hold a position, you can get a stop out. Solutions to the first scenario: avoid entering. If you see this breakout downside and then wait for the pullback and then take a look at this signal bar. This bar is not very strong because the body accounts only 50% of the whole candlestick. So normally it is not a very strong signal bar. And also you can see the tail at the bottom is larger than the tail at the top, which means the body is leaning to the upside rather than the downside. So in general, this signal bar can be in discussion whether it is a good signal bar or not. If it is not, then you shouldn't be entering upon seeing this bear bar. Second, whether we have any important levels on the chart. Apparently on that day, we have the 4,000 point level here. So the market just reached the level and then bounced back. So that's why it is not a very good point to enter the market as well. We want to see whether it's gonna penetrate this 4,000 level or not before we enter the market. Solutions to the second scenario. If you're already in a trade. So basically what you can do is when you see the market is not going down immediately, not as expected, then what you want to do is close your position first with a small loss or maybe with a small gain. It depends on when you close your position. So when the things are clear, let's say after a few bars and then there is a strong signal bar to the downside as a bear bar, then you can re-enter the market. If you still believe that it's a strong downtrend and you want to hold your position, at least you want to give a tight stop to make sure you don't lose much. For example, if you move your stop immediately to the top of this pullback to avoid further losses.